Hello traders, I am Stephen Davis, Senior Market Strategist. Friday, October 30th, here to talk to you about the grain markets this morning. We're a little bit higher this morning in soybeans and corn on what has been a defensive tone all week long. Corn market. Corn has a strong correlation to crude oil and the dollar. So if crude oil could trade higher and continue that trend and the dollar trade lower and continue that trend, that would help the corn price go higher. Bullish commodity traders, bullish corn traders are hoping for a lower dollar and a higher corn market. Wednesday, it was interesting. Crude oil was sharply higher and the corn market barely moved. So corn harvest wrapping up here. That should be a short-term positive here in the Midwest. Soybean market. I want to make a correlation between cotton demand and soybean demand. So cotton and soybean and cotton. I've been doing this all my life, been around the markets. I remember a lot of things, the 1987 stock market crash, Chernobyl. I remember cotton traded $2 a pound a few years ago. Today, December, cotton's $62.50 as we speak. There were some cotton millers that had been around 100 years that were out of business on this spike higher. Unbelievable. So the demand for cotton's never going to be the way it was 10 years ago. The consumer wants more in what they buy than just cotton. The demand for soybean in our lifetime is going to continue to increase. The soybean is the legume, the protein that the world wants and needs. The consumer gets what he wants. We had headlines this week in the newspapers, carcinogens of processed meat. That caught all of our attention, and we all read it, and that's going to last 2 days, and we're going to go back to eating bacon because bacon on everything is delicious. The consumer gets what he wants, hence the demand for soybean. Getting back to corn a little bit, you're not going to see corn rally. Maybe we're going to trade sideways until the end users of corn start making money. Ethanol margins are terrible because of lower crude oil prices. The livestock industry, nobody's making any money there. Corn exports, there's rumored to be a cargo of corn from Brazil coming to Wilmington, North Carolina. So all this corn in our country, and we're importing corn from Brazil. The strong dollar certainly has something to do there. So option trading on grains, I've been talking on this now. This is big, and we're in about the third inning of this. Spread trading on options in 2010 was 10% of the Globex CME volume. Today it's 46%. So here's option trading on the computer screen exploding. All of us in this office, we all have clients around the world who are trading options. Again, we're in the third inning of this. Stay tuned. So with this computerized trading comes transparency, and there's some issues. There's a spoofing trial going on in Chicago this week. High-frequency trading has got its pros and cons, but it's liquidity, and liquidity is good for all of us. So stay tuned about that. We're going to talk more and more about it. It's the end of the week, the end of the month. The monthly charts are very, very interesting. So if you're looking at something, give us a call. Have an excellent weekend. Futures and options on futures may involve substantial risk and may not be suitable for all investors.